The third week of our training course focuses on the linking of emission trading systems that differ from each other in the level of environmental ambition. As you know, different types of linkages exist, and later in this introductory video, I will implicitly refer to full bilateral linkages. But let us start by thinking for a minute about the very meaning of environmental ambition of an ETS. While a formal definition does not exist, the environmental ambition of an ETS generally refers to the quantity of abatement that an ETS promises to deliver. Accordingly, the ambition of an ETS may be assessed considering the following three dimensions: emissions coverage, stringency, and determinacy. The emissions coverage of an ETS simply is the share of a jurisdiction's total emissions that are regulated by the ETS. Say for the EU ETS, emissions coverage is currently about 45% of the EU's total greenhouse gas emissions. For California's ETS, emissions coverage is about 80%. Stringency refers to the level of targeted abatement at a certain point in time or over a certain time period. In theory, abatement is relative to business as usual emissions, that is, emissions that would materialize if the ETS was not there. But we will get back to this in a minute. Determinacy refers to the degree of certainty about regulated emissions stay below a certain level. Importantly, this dimension allows us to distinguish between absolute cap ETSs, also known as cap-and-trade systems, and relative cap ETSs. Examples of the former are again the ETS or California's ETS, which by design ensure that emissions stay below a certain level. Conversely, China's ETS will be a prominent example of a relative cap ETS, which allows for higher or lower emissions depending on the evolution of output. Now, as I said, target stringency refers to abatement relative to business as usual emissions. The issue with BAU emissions is that their estimates necessarily come with a margin of error. Therefore, alternative stringency measures that are commonly considered are, first, targeted abatement relative to historical emissions, and B, allowance prices as a proxy for the system's marginal cost of compliance. Between these two metrics of stringency, there are multiple reasons why allowance prices are preferable. Unfortunately, we do not have the time to discuss these reasons just here. In any case, however, when comparing allowance prices across ETSs, one needs to keep in mind the many various factors that, along with stringency, determine allowance prices. Broadly speaking, allowance prices are a function of allowance scarcity and a function of multiple possible market distortions, which include policy uncertainty, investor myopia, market power, and other possible factors. Differences in environmental ambition between ETSs have different implications for their linking. The literature commonly distinguishes between economic, environmental, and political implications. In partial equilibrium analysis, the basic efficiency gain of a linkage stems from differences in marginal compliance costs between ETSs. Insomuch as they do reflect differences in marginal compliance costs, pre-linked differences in allowance prices are a key indicator of the efficiency gain. The efficiency gain will partly accrue to the high-price ETS, the net buyer, in the form of abatement cost savings, corresponding to the Y triangle in the graph, and it will partly go to the low-price ETS, the net seller, in the form of revenue from sold allowances, corresponding to the X triangle in the graph. Important when allowing for administrative costs or for general equilibrium effects, it is possible that a jurisdiction does not expect a net benefit from linking its ETS to another, and if so, it will not engage in a linkage. As far as environmental implications are concerned, the question is whether differences in environmental ambition between ETSs that consider linking can lead to greater or smaller total abatement than if the same systems operated independently. The literature emphasizes situations that result in increased emissions. Notably, linkages between absolute and relative cap ETSs can be risky, in that as a result of linking and of the consequent adjustment in allowance prices, emissions may increase in the relative cap ETS. A second way overall emissions may increase is if linking of any type of ETS induces strategic loosening of the stringency of an ETS. At a minimum, therefore, a linking agreement should prevent this eventuality. On the other hand, however, linking also offers an opportunity for cooperatively increasing environmental ambition. By reducing the cost of achieving a given emission reduction target, linking offers the opportunity to embrace a more ambitious target. Political implications of differences in environmental ambition are also potentially decisive for a linkage to take place and for its success. Political challenges arise with two types of distributional effects. One is the revenue transfer between jurisdictions. For a jurisdiction that is net importer of allowances, substantial revenue transfers from the domestic economy into that of the exporting jurisdiction might not be politically acceptable. At the same time, changes in allowance prices after linking determine winners and losers within each jurisdiction. Allowance buyers in the high-price ETS and sellers in the low-price system benefit from the link. Conversely, allowance sellers in the high-price ETS and buyers in the low-price system will suffer financial losses. Finally, a third political factor that can weigh decisively against the realization of a linkage is the partial loss of policy control over an ETS. The limit to policy control regard regulatory adjustments, as well as acceptance of co-determined allowance prices.
With a contribution from the LIFE program of the European Union,